year-to-date low on the 30-year fixed mortgage based off of the news we were talking about in segment one. You can always listen to replays wherever you watch, wherever you listen to pods, CT Real Estate Radio, to download this pod. We were breaking it down on first segment in here where we're looking at the job data that came out on Friday. This was 22,000 jobs, what payrolls rose in August, and it was less than expected. It was a further sign of a hiring slowdown. Unemployment rate ticked up to 4.3%. I mean, I'd argue that unemployment at 4.5 is still fine, but we've been at 4.2 for so long, and we did have an increase there at 4.3. We saw a little bit of a weekly unemployment tick up when we saw that number on Thursday. Here's the big thing. When economists miss in a big way, that kind of spooks the market. Economists surveyed by Dow Jones have been looking for payrolls to rise by 75,000. Again, 22,000, another miss. And this sent the 10-year Treasury down to its lowest level in 11 months. Really, there was a couple of days in April we were at this level, but we haven't been at this level all year. It's driving down mortgage rates to year-to-date lows. And what does this mean for home buyers and really anybody looking for home financing?
Yeah, so I mean, I think things are going in the right direction. You know, a lot of times when you hear the folks in charge at the Fed or just the economists in general, they'll say, you know, we want to wait and see the data. And, you know, what they mean by that is what's the trend? You know, what direction are we going? And sometimes it's hard to tell what the trend is when you only have one data point. You only have 1 month showing direction. Now, we've got 2 months now. We have 2 months in a row showing that the number of job growth numbers have gone down.
And they've revised previous months to go down even further.
2 months in a row, they've revised the previous months. And that happens because the job surveys do come in slowly. They survey employers to see how many people they're hiring. You know, imagine if you're planning your wedding and you send out a bunch of invitations, you get some of them back within 30 days. Some of them trickle in later. So that's why they do those revisions. But you absolutely great point. So not only have the 30-day numbers been low for 2 months in a row, but the look back at the last 90 days has been revised in August and September reports. So, you know, we have the data, you know, so whenever they say we're waiting to see the data is here. You know, I always say all the time, like, you know, you can't really count on the forecast. It's difficult to predict the future. You know, even earlier at the beginning of this week, people were asking me what's going to happen with rates. And I was telling people all week, I'm like, it really depends a lot on this Friday jobs report. I mean, if that report had come out and shown that there was a lot more new jobs created than people expected, we would be having a very different conversation right now. But that's not what happened. The data came out yesterday, showed 2 months in a row, low job numbers. I think we are on our way to lower mortgage rates, and it's happening already. You know, Friday was the lowest mortgage rates of the year. So, I mean, I think that the refinances have definitely picked up. I did a couple refinances this week. So far, most of the people I've been talking to have been kind of people that paid cash for the property, but they really wanted a mortgage. They didn't want to take a mortgage, you know, in the sevens. So now they're seeing this in the news that rates have come down. So they're happy to get a rate, you know, maybe in the mid sixes or low sixes, and they're maybe going to pay some points to get a rate in the fives. So I think that'll continue. I think if you did buy a house in the last 3 years and you have a rate that starts with a 7, the news cycle is good right now. I mean, it could change in the future. It definitely could go back up. I mean, if we get a positive, strong jobs report on the first Friday of October, that could make the rates go back up. So, you know, it's not a guarantee it's going to keep going down. So, you know, strike while the iron is hot. You know, if you can pay some points and get a rate in the fives, you might be good for that might be the best you're going to get in the next 10, 20 years. I don't know. But that you might not need to refinance again after that. So those are the kind of conversations I'm having with people. As Byron mentioned, I do have a website. If you want to schedule a time to look at your mortgage, go to scheduleloanappointment.com to schedule a 30-minute, 15-minute phone call and give me your numbers and I'll tell you what I think about your mortgage.
Yeah, Brian, a lot of people are like, why, if you own your house cash, why would you want to refinance it and take that cash out of the home at 6%? Why would you want a 6%? Because 6% is well below the 50-year average on the 30-year fixed mortgage. That's up over 7.5%. And so, you know, it's not that difficult if you're just adequate at business or investing to make more than 6% on your money. Okay, so when you look at it that way, why would somebody take money out of their home at 6%, and they sound off as if the 30-year fixed high at 6% is high, and why would you want to pay that? Well, because if I can make 9% on my money and keep the difference of the 3%, I'll do that deal every single day of the week. And there are a lot of people that can make double digit, if they're running an effective, they can put the money into their business and, get a bigger return. Then yeah, it makes complete sense to borrow the cheap money at 6%.
The other thing that
People
happened,
don't think
go
cheap
ahead.
money at 6%, it's at 6% anymore. They want it to be even cheaper. They want it to be free money.
Yeah, I mean, the other thing that I see happening a lot in the last couple of years, I mean, remember in October of 2023, mortgage rates were at like 8%. And there were folks that just needed to buy a house for various reasons. They had a baby, they moved, they got a new job, they had to buy a house. They were not excited about what the rates were at the time. And maybe they had a family member that said, you know what? I've got an extra 600,000. I can give it to you for a couple years, but once those rates go down, I want my money back. And
The
so that happened quite a bit in the last couple of years, and people have just been waiting for rates to go down because it's not always fun to like owe money to your family, and so sometimes it's just nice to get out of that and just get back into a regular mortgage. And people have been waiting for more reasonable opportunities, and they have arrived.
Yeah, I mean, especially if you're at 8%. 8% never needed to happen. 8% mortgage rates did not need to happen if the Fed acted appropriately, non-politically, back when they had the opportunity to do so. Instead of saying that inflation was transitory to give Biden a money printing machine in the first year of his presidency. Anybody can go back and look this up. When did Jerome Powell first say we need to do something about inflation? It was exactly 8 days after being reappointed. If you don't think Jerome Powell plays politics, just look at that example. He waited until he was reappointed and confirmed to have his seat as the Fed chairperson by Biden to then start telling the American people the truth about the inflation that he caused in the first place by convincing Congress to print a whole bunch of money. So the rates never had to go to 8%. He let the economy suffer by not increasing the interest rate sooner, and he could have done it at a slower rate. He had to ratchet it up very quickly. Now, when you look at what they're going to be doing, and they're going to be cutting now with where the job market is, the job market's an indicator of a weakening economy, a potential recession in the future. Okay. And you would imagine with that type of indication that the stock market would be moving. Stock market is still hovering around near all-time highs. I mean, it's hit so many all-time highs over the last couple months. So here's what I think about investors. Investors, one, do not believe that if there is a recession, it'll be a deep recession because they have their money in equities. Number two, investors really believe in the decisions being made by this administration. They believe that the tariff and trade deals are good deals. Okay, they had a reaction initially, and what happened? All that money plowed back into the market when they started seeing the deals being made. Investors do not believe we're facing a huge, deep recession. They believe in the decisions that this administration is making, like trade deals, and basically re-underwriting the entire way America's financial system works. Investors are backing that. We'll see if they're right. But they're not taking their money out of the market just based on a job scare, and rates might come down, and there might be next year, 2026, a boom year if they're right.